Okay, welcome everybody to Wall Street Reporter's next Super Stock live stream for January 13th, 2022. We are back for the first interview of the year with Organic Garage. Matt, welcome back.
Jack, good to be here. Happy New Year. Off to a good start. So yeah, it's good to be here.
Absolutely, yeah. And I think 2022 really is a big year. I know this is the big year everybody's been waiting for. You have a lot of things lined up. So 2022 really is going to be the breakout year. This is like in a lot of companies, they build for a while. There's like a gestation period, and then all of a sudden there is like the breakout, and that's when that becomes the next 10x plus super stock. So it looks like you have a lot of things lined up. There's a lot of catalysts lined up right now. The company's already, at that inflection point. So, we're going to go into an update, and hopefully we have a lot of audience questions. Yesterday on our live stream, we had some tremendous questions. I hope everybody's back from vacation. So for anybody that's brand new to our program, our goal with Wall Street Reporter's next Super Stock live stream is to bring you those stocks which have that 10x to 100x upside potential. In the last 18 months, we've already had 9 of those stocks that have increased 1,000 to 5,000%, and hopefully we're going to have another 10 more of these 10 baggers in the year ahead. Maybe Organic Garage could be one of them. He definitely has all the ingredients in place to be that 10 bagger. We'll talk more about that. So again, the key thing today is we'll go through a couple of questions with Matt, but really it's the audience questions that make these things special. So please, guys, ask your questions. Don't be shy. All right, Matt, that said, you get a lot of new people in the audience today. It's a new year. So let's kind of start off with, for anybody that doesn't know, what exactly is Organic Garage?
Yeah, no, Jack, I appreciate that. And you're absolutely right. I mean, there's lots of new people to our story, people hearing about us, which is super exciting to see and hear. And for those of you that don't know, yes, there's two sides to Organic Garage. We have a retail division and a consumer packaged good division. Our retail division is branded Organic Garage. It's an organic and all natural grocery chain with 4 locations, focused on providing everyday low prices for people buying organic and all natural products. We're a one-stop shop. We cover every category in 10 to 12,000 square feet. And so we want to be your go-to grocery store looking for organic and all natural products. And then on the CPG side, we made a very exciting acquisition last year, a company called The Future of Cheese, to access the plant-based kind of food movement that's transitioning through the food sector. I always like to say this is not a fad. This is a trend that is only growing. And we saw a unique opportunity to acquire a very good company called The Future of Cheese, co-founded by 2 excellent people, Afram Pristine and Craig Harding. I suggest anybody who's new to this story, you look up their bios because they're stellar. If you're existing on this story, you already know their bios are stellar. And so launched 4 SKUs in the last quarter basically of the year, starting in late October. So we have 4 SKUs out in the market, and we have some very exciting stuff we're looking at for this year that I want to be able to go through.
Okay, great. No, definitely. Look, the companies, you're in the right place at the right time. This is like one of the big themes, which is plant-based food. Like right now, I think we just in one of our on our Twitter thing, there was a story yesterday about like there's there's more and more like restaurants like Michelin star restaurants that are going plant-based, and again that's the leading edge kind of, and then you have everything, but really it's the whole thing is going mainstream. Like you had the Beyond Meat. The Beyond Meat I think was really the thing that kind of cracked open the thing for fast food to start offering these things on their menu. And of course, what's interesting, maybe we can go into that more, is you took a very interesting approach with kind of your strategy in plant-based, is that you're doing what do you call it? They're staples. You're focusing on sort of the staples, which is butter, cheese, and things like that, which are the dairy alternatives. But these are things which are used in massive quantities every day. Like not everybody eats meat or fake meat, Beyond Meat every day, or not everybody's gonna eat fake fish or whatever it is. But butter is like it makes everything taste good, and cheese.
Yep, we got a great response. This response was overwhelming when we launched the products. We got picked up by publications. Our plant-based brie, was named, one of the top 10 products to watch for this coming year by Veg News. The most realistic plant-based brie that's out there in the market. So just, our goal was to get products into the market to show people, what I knew firsthand after trying the products, how good they were. And we proved our point in terms of the response we got. And you mentioned restaurants. We had some local restaurants here pick up on the products, start using the products on their menus. It's unfortunate what's happened with obviously Omicron and COVID with restaurants in our local market.
But it's everything is.
This
is it. This is the year everything is going to go back to
But yeah, we're well suited and well placed to capitalize on that market. You're absolutely right. Restaurants are looking to diversify their menus and get into plant-based foods on their menus to satisfy a new and emerging market that's growing very rapidly. And so it's no different than on shelf in grocery stores. So we're well positioned. I want to be able to go through what we accomplished this past year and what that means for next year. We'll walk through the Q3 financials, because I know people always like to hear it from the horse's mouth, so to speak. So I'm here to speak.
Yeah, there's definitely going to be questions about that. Yeah.
And so yeah, absolutely.
We'll address that. So it's interesting. I was mentioning the restaurant thing. So the story we put out was, I think there's a restaurant in New York, very famous place called, I think it's 11 Madison Park, which is I think they have like a Michelin, I don't know, a couple stars, 1, 2 stars. And the guys go, they were closed for COVID and they reopened and they're going all plant-based, which is crazy. I mean, this is, it's pretty shocking. So that's, this thing is right. And of course, one of the things that these guys really need is good quality plant-based butter. You can't have any, decent food without butter, right? So now it's interesting. Essentially, organic garage, the concept with your stores, for some reason I just thought of this now, is the concept with your stores is, it's quality, organic, it's all organic food for less. I mean, it's like a discount pricing model.
Yeah.
Now the future of cheese, which is future of butter, which is your plant, the branded CPG stuff, those are kind of, they're like premium products, or the premium pricing, right? They're like quality.
I don't want to say that, because if we know the market very well in terms of when we look at competition within the plant-based butter market, and we're market priced to compete with the other brands that are in the market. The plant-based brie is a unique SKU. It's very hard to compare. A lot of plant-based companies started with very basic, the cheddars and the mozzarellas. But given Afram's background, once again, I don't want to spend, too much time, but for people who are watching this program, check out his bio, because he is Mr. Cheese. But he curated a plant-based brie that is second to none. And so when we launched into the market, in terms of the cheese scale, it's on the more premium side, but well priced for a brie, when you compare it to its dairy equivalent.
Yeah.
And just blew me away in terms of the response, blew customers away in terms of the taste profile. So yeah, I don't want to say it's premium price. It's at market price for
it's basically future of cheese. We call it, it's like the Tesla of plant-based butter and cheese. Now, because again, it's still the electric vehicles, just like Tesla, it's still relatively a premium category. But within that, you have your super high-end Tesla that's, I don't know, like $100,000, and I think they have ones for like $35,000. So it's but it's still it's a unique thing. So you're really like the Tesla of the plant-based space. Now, one thing also is this market, again, just for anybody that's new, it's a $600 billion market opportunity. Dairy is $600 billion worldwide. We've seen that, Oatly has, had a massive increase in sales. Their stock, they IPO to kind of, might have, they were probably hit with the market last year, but it kind of validates.
It's not a trend. This is the trend that you're addressing. It's not a fad. It's a trend. Sorry, excuse me. It is a trend, and it's only growing. So, we've seen a lot of fads over the 15 years we've been open on the retail side come and go. This is not a fad. This is a fundamental shift in consumers' buying patterns, and us accessing the market allowed us to enter into something to provide, enhanced shareholder value in a hot space, and a space that we know very well. we're at the epicenter of the plant-based food movement. We see things before the large guys do, the large chains do. We have brands constantly approaching us, and so we get to see that firsthand and have a very firm understanding of what is happening in the plant-based food side, and what is hot, what is not, and plant-based dairy is where it's at. So it's a fabulous opportunity.
It was a conscious decision to start with that vertical, the dairy alternatives, versus something else.
Yeah, well, milk, butter, eggs. I mean, they're the staples. So it made sense, for us to access a staple, and that's why the first 2 SKUs we launched were plant-based butter, because it's used every day, and then you can go from there. And so we continue to grow that, and so yeah, absolutely.
Right. No, it's interesting. I was just aside. It was milk, butter, and eggs. Actually, it was. You said it's a staple, but actually, I think it was kind of like a staple of. I think people don't realize that, but it's like it was a staple of all like food or like groceries, like for hundreds of years or something. Because like
on the grocery side, I mean, those are your benchmarks. People forget how often those ingredients are used in other things as well. And so, those are the staples. And so having plant-based butter is the bedrock of, our kind of SKU base.
Right. No, it's interesting. I remember there was in New York, like in the Tribeca neighborhood, like I don't know, 30 years ago, there used to be still old loft buildings which had like milk, butter, and egg wholesale. There was that was the district for the milk and butter wholesale. And there was a futures market also. So this is not a new thing. What you're doing, it's basically it's been around for forever, and essentially we're going in a new direction with the plant-based thing. So massive market opportunity, multi-billion-dollar market opportunity.
Absolutely.
And we're going to go into I think the main thing we're going to focus on today is the path for Organic Garage for the stock. Really, again, our audience want to know what's going to make this a 10-bagger stock.
Sure.
So right now, I think you're at a 25 million plus run rate, exited last year.
Yep.
And what's ahead for this year is, of course, what people are anticipating is they're waiting for the launch of new stores. I think 4 to 6 stores potentially in the next months, which could double the revenues of the business to go to, let's call it a 50 or $60 million run rate. We'll go through all the numbers. I'm sure we're going to have a lot of questions. So potentially you could exit this year, 22, with a $50-60 million run rate. Plus you got the plant-based line, the CPG line, the future of cheese, future of butter, which, and we'll talk about more about the actual numbers, but that could be also 15-20 million run rate. Of course, the valuations for that business are significantly higher. It could be, 5, 10x, whatever. So there really is a path for this stock to go from 40, 50 cents to $2.50. I'm saying even potentially $5 if the stars are aligned with the market and the valuations with comps and everything. So let's but before we get into that, I want to get into a lot of audience questions. We have some great questions coming in. We're going to go to all of them. We see a bunch of good questions. Okay, so we got a lot of questions. So I'm going to ask you 2 questions and we'll jump in because we got kind of a little bit of time here. So Matt, let's one thing I'm sure everybody's going to ask about is, you had the financials came out, New Year's Eve, the last quarterly financials. The market wasn't thrilled. Of course, it was you had that kind of the last of the tax law selling season, and so really the stock ended 21 on kind of a downer. Let's be honest, it ended. We had a nice pop in the beginning, went from 30 to 70 cents. We kind of
love the stock market. Yeah.
So but you're not the only one. There's been other stock. It's actually a lot of the small caps are down. But so people were confused by the financials. Can you address exactly they thought, oh, why the revenue's down or what's going on here? Look, maybe
and look, I love talking about it, and I never shy away from the numbers, and I know them, inside out, upside down, and backwards. And so it's great that you bring it up because, I didn't see anything concerning. I thought we had a great quarter. So let's start with top line revenue. Look, we expected, when we compare year over year with what happened with COVID and the COVID kind of hoarding that went on, we benefited way more than most retailers. We had an explosion of new customers coming to our stores, and our sales spiked much higher than what other grocery chains in the sector experienced. And so we expected things to level off. And especially here in Canada, it's been hard. It's a little bit of like we open back up, then we shut back down, then we open back up, then we shut back down. And so gauging kind of consumer response, it's always hard in terms of, what the consumer is doing, where they're at. When things start to open up, a lot of consumers were like, hey, I got to get out of the house. I got to start traveling again because I've been locked up. And so all those things kind of impact sales, but we expected the sales results that we had. And, for investors that are watching this, or new investors, it's very important you guys also understand that basically one of our stores was under renovation during that quarter. It's continued into fourth quarter, but it's wrapping up. And so it's easy to say it's one store, but with where we're at right now, that's 25% of our store count. And so those things all impact sales. The COVID kind of subsiding in terms of the buying, hoarding, and that went on. And then we had one store that was under renovation that impacted our top line. But the good thing is especially with everything going on, our gross profit margin increased. And that's a direct benefit of the transition out of our centralized warehouse facility and into a decentralized models, that we're seeing incremental margin lift on our gross profit percentage. And so being a discounter and being the lowest price in the market, and yet still pulling a 30 plus gross profit percentage is incredible, and speaks to good things as we continue to scale the business, because we should be able to see continued margin increase as we continue to our buying capacity and kind of buying power increases, and we're able to access better and better pricing. So that was a great on the top line. Look, we'd always love to see, double-digit sales increases, but these last, let's say even 2.5 years has been a roller coaster in terms of the pandemic. But what we do want to see is, are we happy with where we're at? Yes, it was expected. We expected things to level off. And the great positive on that top line is our gross profit percentage continues, to increase. On the bottom line, sorry, go ahead.
Oh, so Matt, so this is actually very important. So like, again, the business you're in, the margins overall in grocery business are relatively thin. So you really need like very tight operations, operational excellence. You got to really run a very tight ship. So can you explain, like, first of all, by contrast, in case anybody doesn't know, like, what are typical gross margins in, I don't know, like, for example, a regular grocery, or I don't know, Whole Foods or whatever, versus yours, and also exactly how you've been able to increase these with this new kind of distribution system that you have?
Well, there's really very little margin left on the conventional grocery side. So non-organic, non-specialty, you're lucky, high teens, low 20s maybe. It's why, we could talk, a whole other program about M&A activity in the grocery space, but it's why organic and specialty is still such a hot category in grocery, because it's a way for conventional grocers to enhance margin. And that's why all the acquisitions are happening in the specialty, and natural space on the grocery side, because it's an overall margin enhancer. So for us being on the discount side, and being a price leader and yet still pulling 30+% margin, speaks to, number one, the relationships we have with our vendors and the sort of programs that we have in place, and the fact that we're hard negotiators. We drive a hard bargain, and we want competitive costing to achieve everyday low pricing. And so I'm very, very proud of that fact, especially in a challenging environment that COVID presented, to be able to continue to increase our gross profit percentage while exiting out of our centralized DC is tremendous. And then, just touching on that, last year was a pivotal point in the company transitioning out of our centralized distribution facility into a decentralized model, because it shed a tremendous amount of cost from our P&L. And you see that in numbers, in our P&L, like things like rent, labor, utilities, transportation, all the things that went into running a warehouse are coming off our P&L each quarter, and allowing us to run a much leaner organization, and leads to one of the points we'll talk about the go forward for this year. But it increases the possible site selections across Ontario that we can access, that we potentially couldn't access before by having a warehouse. And so we're looking further and further out, and I want to touch on that point a little bit later on, because it's very exciting. Some of the things.
Well, let's
that
talk
we
about
put
it now.
place.
So this is okay. So
Yeah.
the big
Yeah,
thing,
no, yeah. I mean, one of the big things that we set in place last year was, engaging, the real estate company Savills to analyze the market, and it helped prove the point that organic garage could easily grow to a 20 to 30 store operation here in our local market, and lots of potential outside our local
That's
market as
just
well.
Ontario. That's just Ontario.
Just Ontario, yep. But definitely, I touched on probably our last,
not including the US, not including
US,
Vancouver,
but just touching
Canada.
on that, I mentioned it on our last call. It was very interesting, and I say this, all the time, but people keep tabs on what's going on and what is hot in retail. And we had somebody reach out from the US, asking us about, our interest in a market like a New York or something like that. Because organic and specialty is still a hot sector in grocery retail, and landlords are looking towards that, especially, with everything going on in, climate change and all this. People are becoming more environmentally focused. Landlords want environmentally targeted retailers, who are environmentally friendly and, have a good story behind them. And so organic and natural grocery chains are very hot in that space. And so, we're on the radar in areas that we don't even realize yet until we get, the sort of phone calls we got, at the end of the year. So the space is hot. And so when we look at development potential for this coming year, I mentioned in our last call, we're looking at putting together, a 4 to 6 store package. We really want to take a big step. We want to be in that 8 to 10 store range. But above and beyond that, we see potential to take even potentially a bigger step. And so when we look at the Ontario market, we've identified a couple of key areas for us, which is, kind of the Western Ontario, Southwestern Ontario market that could easily support, a 5 to 6 store development package. We look at Northeast Ontario that could easily support a 5 to 6 store development package. And we're actually looking even a little further in the Ottawa region that could support a 5 to 6 store package. So our real estate team has been very busy. We got a ton of sites to sort through. I've been actually out, and Jack, this because we tried to schedule a call, and I'm out on site tours, checking out new locations. So we see a ton of potential on the organic garage side. And the top level economics are, each store, 6 to 7 million in sales. You look at us as a 10 store operation, we're going to be a 60 to 70 million dollar a year operation. You look at a 15 store operation, we're $100 million a year company. And so
with 15 stores is 100 million a year.
15 stores, including our existing 4. And so we're not talking about we got to develop 100 stores to be noticed here. We're talking about very realistic sales goals when you're looking at targeted territory development in terms of transitioning who we are right now into the next kind of iteration of the company, which is taking a big step forward. And I said this before, the opportunities there on the real estate side. We've seen a lot of vacancies, unfortunate for some businesses coming out of COVID, fortunate for us. The model that we're looking at in this 10 to 11,000 square foot range could be a buffet restaurant that closed down. It could be a general merchandise store that closed down. We're not looking, and we're not competing with the big boys in the 20, 30,000 square foot range, and we're not competing with all sorts of smaller restaurants in the 3 to 5,000 square foot range. We're in a real sweet spot here. I always like to say we're too big for the small guy and too small for the big guy. So it's a real sweet spot in terms of space. And so it's been keeping us very busy on the development front. And so, setting that bedrock last year, transitioning out of our warehouse, engaging with our real estate team, analyzing the market. I like to throw in there, we redid our logo in anticipation of store growth to make it easier for people to understand who we are as a company, and we're focused on value and price every day. And so, last year was a real, page turner for us in terms of, setting that bedrock principles, bedrock foundation in place to really take a big step forward, for this coming year.
Okay, so we're going to jump into the audience questions in just a bit. They're piling up. We got to get to them. Okay, so just to be clear, so you can get to $100 million with just 15 stores in like your local region in Ontario, which is pretty easy. Again, we've talked about it before in some of the earlier live streams. For anybody that's brand new, that we have a video where Matt actually does a walkthrough through one of their stores. I mean, you really have a very unique, and again, I think people who are familiar with the company, they kind of take it for granted, kind of the unique business model that you have in place, sort of the merchandising model. Like, it's a really unique store experience, and that's what people want these days. For people to want to go into stores or or get things on. They want that connection and want something, or an authentic brand, something, they want an experiential type of thing. And so yes, so to get to 15 stores would be very easy because you already have the thing in place. Now you have the big margins, which is very important. You have this your distribution model now. It would ensure that the new stores would be extremely profitable because of this kind of distribution setup you have.
We've completely streamlined our P&L by removing the centralized distribution facility. It's just completely streamlined our P&L. So I mentioned our Q3. You know, we continue to deliver on savings every day on our core components. And look, the only thing that weighed on our Q3, and for those that know how to read financial statements, great. I don't have to spell it out for you, but for those of you that don't. Look, first off, you have things like stock-based compensation is a non-cash transaction. It is not something that you should factor for. It's part of doing the business as a publicly traded company, but it's a non-cash transaction. It's not like we outlaid that cash out of pocket, but we have to book it on our P&L. And then the only other things that weigh on our P&L are our ongoing public company costs. So things like investor relations and our uplisting on the OTC, which we had to book those costs and things like that. And then lastly, incremental costs with regards to our renovation of our Bathurst location, which couldn't be capitalized. And so when you compare our Q3 loss to Q3 in the previous year, there was a marginal difference when we look at the adjusted loss. And we do the adjusted loss because we do want to show people, hey, look, there's lots of things that go into financial statements and financial reporting that are either non-reoccurring or non-cash based. And so what we want to do is we want to strip it down for the average investor to say, hey, look, where does the dust settle? Where are things at? And so because people, sometimes they look at one number when they should be looking at 7 numbers, and they look at 7 numbers when they should be looking at 3 numbers. So we always want to break it down to make it easy for people to understand, hey, where we are as a company. Are we happy with where we are? And look, I'm very happy with the numbers that we presented. I'm happy with our cost containment, which is a key thing when you're looking at springboarding for growth. You want to have a solid foundation. You don't want to have fat in there that's unnecessary. And anything that we have booked is what should be booked, and what we have as public company, in terms of obligations to help promote our story. And so I think we set a great precedent for a springboard to jump forward for this coming year.
Okay, so this really is the year of expansion. Now, one thing, Matt, I don't want to insult you and people in our audience, but in the last 3-4 months, most of the volume has been coming from the U.S., and we have a lot of U.S. investors. They don't know where Ontario is. They don't care about Ontario. They want to know is you have a great brand, right? This is a perfect brand for the U.S. market. There really there is a massive demand in Canada. In Canada also, but there's really a massive demand in the U.S. market for what you're doing, especially given what's been happening in terms of real estate development in the last, I don't know, let's call it decade, and it's going forward, where you have these kind of new multifamily, 4 or 5 story buildings, apartment buildings you see going up in every city, suburb, etc. And they have this, the ground level. It's a perfect thing where they want to have a 10,000 square. They have a 10,000 square foot space essentially, and it's a perfect match because, like you said, they're looking at these landlords. They see what you're doing as you're like a value add tenant. So for them to have, organic garage, it creates a halo effect for the whole development. Essentially, adds value, and
the brand. Look, the brand is so strong. We said, look, we're focused on developing in our domestic market. It doesn't mean we ignore outside our domestic market, either nationally or internationally. And so we've always said, from a licensing and partnership standpoint, the brand commutes well to any market, given kind of the experience that we've created inside the store. And because of the category that we're in, and it being on trend and hot, it's in demand. So it's a double whammy. You're in the right place at the right time in terms of what people are buying, and then you add in the branding component and the style that we developed for our stores, and kind of our focus and how we just communicate with customers and everything that makes us very unique. It's a double whammy that doesn't exist in the market. And so we got people that reach out to us and say, look, have you ever thought about opening in this market? And like I said, I mentioned last time I was on the call, we had a conversation with a US-based developer in the New York market that was asking us about potential for developing there. And we said, hey, look, we're always happy to have conversations with people. Where they go, I can never promise, but we're always open to opportunities. And when it comes to national or international expansion, it's about linking up with the right partners who know the domestic markets well, and working with them on our brand and our style of merchandising and how we communicate to customers and our products selection to help develop in a local market, and deliver on the Organic Garage experience. But we're never ignoring any opportunity that comes across our way.
Okay, so but essentially, I think that it would become even more compelling for expansion in the U.S. for U.S. partners is once they see you have 8 stores in that market in a place like Ontario, then they could say, okay, well, if this guy can scale to 8 stores, we can do this in a place like, I don't know, Phoenix, New York, I don't know, whatever.
Yep.
Los Angeles. They're very similar sized markets, right? I think how many people in Ontario? There's like 20 million or something, or 10 million.
Yeah. I mean, look, I always like to say, I mean, Toronto is North America's, I think, 3rd or 4th largest city. So it's not. We're not in some small town in the middle of Canada or something. So it's a good test to understand what the capabilities in markets like the U.S. But you're absolutely right. Look, we identified we wanted to take a major step forward. We always felt that the 8 to 10 store range was a key milestone for us to get over the hump, start churning out dollars to reinvest into store expansion and to take some major steps forward and to be a major player in the market. Look, we're already a major player, with our 4 stores. We're well known. We're known across Canada. We're known now, internationally, because we get calls from places like the US. So, getting even bigger means more for us in terms of market exposure. So we really want to take a step forward.
Okay, so let's say a US deal. Again, I want to get into the audience thing. So US deal, in theory, I mean, it could happen, it could happen in the next couple of months. In theory, let's say you start getting the stores. I mean, you probably, there are people who are watching what you're doing, and you might get somebody, like I don't know, an area developer. I don't know how it works in a franchise or a license. You might say, hey, let's get. I mean, somebody who's an experienced operator can do this quickly, right?
Yeah, it could be somebody watching your program, Jack.
There's
on. Absolutely.
Matt, we have the A-list. This is the A-list of the business community. It's not just investors.
Look, we don't ignore any opportunity. We have ongoing conversations on both sides of our business, the CPG side, the retail side. We're a growth story. We spent last year, focused on so many milestones that we helped outline in our corporate update, which you definitely want to touch on and also answer some questions. But, we've set the framework now for growth. So the question is for this year, what are the key milestones that we see out there on both sides of our business? On the Organic Garage side, I've outlined, we're focused on a 4 to 6 store package in terms of development to show the run rate towards our next evolution in size. And do I feel that potentially it could be more than that? Yes, because I feel that the markets that I just outlined can easily support 5 to 6 stores each, and you're talking 15 to 18 stores right there in those 3 geographic areas. So the potential is definitely there. And then on the future of cheese side, the momentum has been set. We put the products out into the market. And when you look at the 4 benchmark milestones that we outlined in our corporate update, which will propel that company to the run rate that we think it can easily hit, if not way more, shows the potential for that brand to be a key contributor to the overall.
But there's I mean, you have right now all the ingredients are there to do just with to do basically 50, 60 million run rate by the end of the year, by the end of this 22. So which could be essentially the stock could be worth let's call it 4x, 250 million valuation. So that's a 10 bagger from here. I mean, that's why I'm excited about this thing. Is people asking why why do you keep focusing on this Organic Garage? So because I look at it as a very de-risked. There's like almost no downside risk, and the upside is basically a 10x. So this is it's just a stupidly easy investment decision. Again, we're not giving investment advice. On that note, let's go to audience questions. Mitch, what are revenue goals, plans for future of cheese? What are your goals?
So look, last year was a huge year. I mean, when you look at, when we start with the acquisition of the company, integrating it into the company, which is, not something that should be taken lightly, which was a huge accomplishment for last year. adding to the management team. For those that have seen this program before, you've seen somebody who's on our advisory council, Yossi Herber, who's been on several times. Tremendous amount of CPG experience, talking about the potential of the business, why he loves what we're up to, which was a great addition to the company. Launching the products out into the market starting late October, huge accomplishment, never easy, should never be underestimated. Physically putting a product out into the market, which was a huge accomplishment. And not only that, not just one product, not just two, not just three, but 4 products in a 6-week span. Unbelievable. Took a lot of hard work, but set the framework, for going forward. So when we look at catalysts and what we're looking for this coming year, on our last call, I outlined, 4 key things for us. Number one was solidifying our co-packer. We've had a couple of questions, people, what happened? We announced the co-packer, previously. What does that mean for going forward? Look, co-packers have all sorts of different strengths and weaknesses and different capacities. Understanding what we saw with the launch of the products, we realized we have to be, add a few more co-packers who can help increase our capacity and focus on a more rounded approach in terms of the SKUs that we're looking at launching in the future. So our immediate focus is focusing on, solidifying a co-packer that can really help us scale. So the team is very busy. We're looking at co-packers in the US, not just Canada. So just keep that in mind in terms of US expansion. So yeah,
this is international products.
International. We are
US.
We are well aware of the capabilities and capacity for the U.S. market, and so identifying a co-packer in the U.S. So our team is very busy, not only in Canada but in the U.S. So co-packer is number one for milestone. Number 2 is working with the co-packer to solidify the 6 recipes that the team has been busy with. You always kind of do that with a co-packer in kind of unison with them because they're the ones that commercialize it and help scale it. The team basically has the majority of those recipes already in hand, which is great to see, because I said it was a 10 SKU package. We wanted to get to 10 SKUs before really pushing, the product out into the market. So that's milestone number 2. Milestone number 3 is linking up with a quality national distributor. I always said in previous programs, we have those sorts of relationships now being a retailer. So we help give that leg up. These aren't cold calls to distributors. We have those relationships if and when the time is ready, and we have the co-packer and the SKUs in place. And then the 4th is linking up with at least one large retailer. And the reason why is because I outlined the math on previous programs. Is when you look at 10 SKUs and our SKUs are packed 6 units per case, they're not big cases, so we're not asking for people to buy a case of 12, 24, 30, case of 6. Keep it very easy, simple math. 10 SKUs, 6 units per case, an average cost to the distributor, not the retail cost, not our manufacturer, cost to the distributor, which is what the company gets in terms of our revenue base of $5 a unit, which is very reasonable because some SKUs will cost less, some, our butter costs less, and our brie costs more. So when you look at an average $5 cost to the distributor, 10 SKUs, 6 units per case in 500 doors, okay, 1 case per door per week, you're looking at an $8 million a year company. That's very simple math. That you can multiply it out.
And that's a very low bar, 500 stores. Again,
that is because 500 doors,
yeah.
And I'll tell you, even with large retailers here in Canada, we could hit that with one retailer. That doesn't even include the US. So you can multiply it out. If you're in 1,000 doors, if you're in 2,000 doors, if you're in 4,000 doors, you look at, we talked about Oatly is in 65,000 doors across North America. So we're not speaking out of turn here in terms of unrealistic numbers. And so that is the basic math. And so when we look at those key bedrock milestones, co-packer, get the 10 SKUs, link up with a distributor, and hit a large retailer for the coming 12 months. Those are our 4 bedrock milestones for this coming year that we want to hit. They're all realistic bedrock milestones that the team is actively working on even before this calendar year started, but going into this calendar year. That is the run rate and expectations that we want to hit. Doesn't mean we're going to hit $8 million in year sales this year, but it means that we want to show we want to show the run rate potential for the company for this coming year. We want to set those bedrock kind of milestones in place that allow the company to scale very rapidly. And so that is the game plan for this coming year for the Future of Cheese company.
I think it's it's a very conservative number. I mean, there's publicly traded, plant-based companies. There's a whole bunch of them in Canada or in maybe the US now also. But none of them have big revenues. They all have a few million in revenues, and some of them have huge market caps. So like right now, if somebody is looking at Organic Garage, the market cap is like 20 million US, 25 million, and just this business alone could be worth 50 million. Plus, you add the grocery, and this is just with the 8 million revenues, which is nothing. That's based on 500 doors. That's like this 60,000.
Could be one retailer. Yeah. Remember, doors doesn't represent retailers in terms of different retailer companies. It's how many physical stores are you in? And so, here in Canada alone, we could hit that with one of our larger retailers. That doesn't include the potential in the US. So that's why they're very conservative, very realistic numbers. This is not pie in the sky math. This isn't like a figment of my imagination. They are realistic milestones to hit. They are realistic numbers to hit. And what we did in the last part of 2021 was show the market potential with the quality of SKUs that we launched, the media pickup that we got from publications like Veg News and things like that. Just tremendous. And it's in a 6-week period, basically. So it just shows the potential for the brand as we look for this coming year, and why I'm super excited. And the potential is unlimited for that company. And you're right, it doesn't even include the OG retail side of the business, which I've already outlined the potential there. So it's growth on both sides.
Yeah, and I should add, Matt, is that one of the key things is that, look, the most important thing for investors to understand is not only, everything that you're saying is actually very conservative and deliverable, because everything that you told me before you actually came on our program, you've delivered. I mean, you've been launching the products week after week. There's been news flow. So this is, so like there's a consistency there and there's a track record. And I think that investors watching this can feel assured that, okay, if this guy's saying that they're going to do at least 8 million, it's going to be at least 8 million. So these things are looking good. Let's get to audience questions. We've got a couple minutes left. Will e-commerce launch coincide with co-packer agreement for scaling?
Yeah, great question. No, absolutely not. We can handle e-commerce through our existing production capacity now. So it's not tied to necessarily a co-packer. We see e-commerce, nationally as a way to, penetrate into consumers' homes without a brick and mortar presence, which, would happen at a later date, with a co-packer, with a distributor and things like that. We are getting inundated on the Future of Cheese social media side and email side with consumers who are like, how do I get my hands on your products? And so we realize, hey, look, we might not be able to be in a brick and mortar store like tomorrow, but hey, we're going to have an e-commerce strategy. We're going to be able to get product into your hands, into your mouth, so you can, taste for yourself why I'm so hyped up on the potential for the business. And so it's not tied to a co-packer. We can handle an e-commerce strategy with our existing production capacity.
Okay, good question here. When scaling up, how do you have enough of the organic ingredients, which is, I guess, fresh vegetables, and for the cheese or whatever? And it's also
on the OGs, if we're talking about the retail side, look,
US.
Yeah, and so we're talking about the Organic Garage retail division. Product availability is always seasonal, cyclical, and can be impacted with things going on with transportation, but it doesn't mean that you come into our stores and we don't have fruits and vegetables on our stand. If I were to take a picture about one of my stores right now, and our produce department looks beautiful with tons of variety. We just got in fresh figs, from Argentina. We got papaya on the stand. We got kiwi. We got gold beets. We got Brussels sprouts, and we got all the staples: Royal Gala, bananas, and green kale. So from that standpoint, I'm not concerned. On the Future of Cheese side, look, the beauty about these products are, and Yossi, our Herber, our seasoned CPG expert on our advisory council, said it himself best, is the beauty about these products are very simple ingredients. These are not 52 ingredient products. We have a couple core ingredients that we use that are readily available, that we've never had a problem kind of sourcing. So there's no concerns from a scalability standpoint on the retail side or the CPG side.
Can you provide some color on the marketing strategy? And I think we've talked about the marketing a little bit with Yossi before, but for Future of Cheese, and will we see more of Craig and Ephraim?
Absolutely. Afram and Craig are super busy in the test kitchen perfecting recipes, but love to be on the program. And look, they're the face of the company. And that's why we said, you know, co-packer for us was the way and the route we set out originally when we were looking at acquiring the company. We don't want to be in the manufacturing business. We want Craig and Afram as the face of the company out for promotional and marketing. And the beauty about, you know, as we're stepping up on the e-commerce side is, you know, with our ability to now ship product nationally, you know, we can start doing promotion and marketing, you know, whether it be, you know, social media advertising strategies to promote the brand to gain awareness, because now we can ship product across Canada. And so, you know, it's why we're looking in the US market for an individual co-packer for the US market, because then we can set up the same thing in the US market. So, you know, the team has been very busy. You know, the first 2 weeks have been incredibly busy with conference calls on not only the Canada side, but the US side, as we're discussing with both markets to access and set up co-packing arrangements for it. Because like I said, I can't speak to enough of the consumer interest in the product, even in the limited time that we've launched products into the market, has just been overwhelming. So we know what the potential is there. So yeah, just very exciting in terms of being able to get Craig and Afram out there on the marketing side once these things kind of fall into place.
Mitch is asking, why not premium pricing? I get, you know, for the future of cheese. Perception is reality in the CPG price strategy. If it's priced low, there is cognitive dissonance.
Yeah, absolutely. Great point. So let me put it in context. Look, our butter sells, the MSRP is $9.99. This is not 99-cent butter. So when we talk about price to the consumer in terms of perception, it is a premium price. You know, the butter's suggested retail is $9.99. The brie suggested is $13.99. So we're not selling things for 47 cents in terms of consumer perception. What is important for us as we're launching the products, what we don't want to be is, we don't want to be necessarily premium priced within the category. You know, we don't want to be grossly overpriced compared to our competition in the plant-based butter space. We want to be a viable product selection within the category that is well in line with our competition. That makes it easy for customers from a price perspective to pick it up, because our product taste profile is so superior. So getting a great tasting product at what is a market price is a win to a consumer. But we're not here to blow out within the category. But like I said, if you compare within pricing perception, it's not a 47-cent item. You know, we're not interested in that.
Okay, so let's see if we can get. We've got a couple minutes left here. So Mike is asking, how many Ontario stores do you need to open before you consider expanding to the rest of Canada?
Yeah, it's a great question. I don't think there is any specific number. Like I mentioned previously, whether it be nationally in Canada or internationally, we're always evaluating opportunities to grow our brand with you know, partnerships and licensing and things like that. So we would never limit ourselves to a specific number before we start looking at opportunities that come our way. You know, our job is to always evaluate opportunities that provide shareholder value and help you know, grow the company. And if that is a licensing or a partnership opportunity when we're at 4 or 5 stores or 15 or 20 stores, we'll always evaluate those opportunities. And if it's right for us, take advantage of them, you know, to benefit the company.
Interesting comment here. Mitch is saying New Season Stores. Do you know who they are? I don't know if you know. Okay, so New Season Stores in Portland, I'm assuming it's a, you know, organic chain, is a great comp for OG. 21 stores, just sold to a Korean retail firm, $275 million, $13 million a door.
Yeah, I mean, I don't know the retailer, you know, specifically, but it just goes to speak. Look, you can look
That's
here
a
in
private
Canada.
market. That's a private.
Yeah,
a private,
you can look, I'm sure, in the US at comparables. The appetite in the grocery sector is in the organic and specialty space. So we're in the right segment of the market. If you're looking at M&A opportunities, you know, just perfect timing. So great example there. Like I said, I don't know the retailer specifically, but there's retailer examples here in Canada that have outlined that we've experienced some M&A, you know, consolidation in our market here in Canada that has spoken to the value that people are putting on, you know, organic and specialty in the space.
Yeah, no, it's interesting. So again, these KSN is saying, okay, tiny market cap, massive opportunity, and to this point, okay, so essentially the stock right now, here's the thing that I like, is the stock right now is basically trading below private market value. So this guy's saying this, this Korean retail for so 13 million a store. Essentially, in New York, they had these Korean grocery stores. Immigrants basically would come, just come right off the boat. They'd open a grocery store, or they would buy a store, and that's like a business that anybody new to the country. It's something where like right now the organic garage is trading at like a valuation. It's probably cheaper than the Korean grocery store in New York. I mean, like 20 million market cap, 5 million a store. This is 13, and this is it's ridiculous. I mean, 10,000 square foot store, five.
It speaks to the opportunity. Look,
this is like a Warren Buffett, classic Warren Buffett investment opportunity. You're stealing this business, right? And anybody who buys the stock at like anything below $1 is basically like, it's like grand theft. It's like it should be illegal.
Yeah, no, Jack, I don't look, the potential on both sides of the business are there. We said it, last fiscal year, we put the pieces in place. We made the transitions where we needed to get to the point where we're at now, which is we want to take a step forward. We want to take a big step forward on the future of cheese side. We've launched the products. We know the products. Now we're ready. Hey, these products are exceptional. Customers love them. We got to scale. And on the OG side, we positioned the business. We got out of our centralized warehouse facility. We trimmed down our P&L and our cost structure. We're lean and mean. We know the opportunity here in the market. We know the real estate is there. Okay, so how do we take a big step forward for the company to capitalize on the opportunity that exists? So both sides of the business are primed for growth, and have key catalysts this year that we're working towards that are very easily achievable to show the potential for the company in terms of its run rate going forward. So like I'm jazzed here. I just 24/7 we're going to capitalize on some of these initiatives.
Let's see. Okay, we got a few minutes left here. Question. I don't know if I asked this already, but if you'd be able to open U.S. stores within 3 years, will there be U.S. stores within 3 years? I'd say, will there be U.S. stores within 12 months?
Yeah, look, I never like to, Jack, I don't like to specify timelines, but what I can say is look, I was blown away by the call I got in December from, somebody who's representing a real estate developer in New York who was following our story and loved the look of our stores. And look, it's not the first call I've gotten, and it won't be the last call I've gotten. So I don't want to say 3 years. I don't want to say 12 months. I don't want to say 24 months, because we're getting calls all the time from people who are seeing who we're about, what we're up to, and it's only increasing as people hear more and more about us. So we would always evaluate any opportunity that comes our way, and if it's domestically, great. If it's international, like in the U.S. market, absolutely, we will take a look at it.
Okay, Matt, let's see. Okay, last question. Okay, so what can investors expect to see from Organic Garage next, let's call it next 60 days between now and, Valentine's Day?
Yeah, our goal, if we're almost halfway through the month here, but I really say in Q1, look, our goal in the future cheese side is to solidify a co-packer. The team, the marching orders have been put forth. We set a lot of the groundwork in December with the calls that the team was having. They jumped on it, immediately in January, but we want to solidify that co-packer in Q1 to put us in line for the growth potential we see for the business. So that is a huge focus for the company, to set out, the other milestones that we're working towards, which is solidifying the last 6 SKUs to get to that 10 SKU mark, link up with the distributor, and link up with a large retailer. But in Q1, our goal is, and the focus is sign up a quality co-packer that we can scale with. And on the OG side, the retail side, look, we're having lots of conversations with landlords. My hope is sometime in Q1 we'll have some new store announcements coming. It's never easy to say, because you ping pong back and forth with landlords and negotiating.
And the new store, Matt, the new store announcement, it's not going to be one store. You're going to announce 4 at a time, right?
We're looking at a package. Yeah, that's what we want to do. And if everything falls into place, that is our hope. Whether it happens exactly in Q1, maybe Q2, but we're working very hard. And like I said, Jack, we wanted to have a call yesterday. I'm out on site tours, so we've hit the ground running for the beginning of the year. And so our focus is taking that next step forward with the company. So those are two good things on both sides of the business that people should be primed, towards looking towards.
Yeah, and again, when you announce the new stores, I mean, just for people to realize, essentially, it's going to be a 4-store package, and maybe we could talk later on why it's got to be a group 4, possibly 6 stores, right?
Yeah.
And what that means, I think, for the market, what that will mean for investors is, okay, that's a signal that this thing is ready to double their revenues or more and increase the profits. So I think the stock will double on that announcement.
Oh yeah.
Maybe I shouldn't say that because I don't want the market to get too forward.
Look, I never guarantee with stock market. It's a mystery in it.
Are you on Instagram, Matt? Are you answering questions on Instagram?
No, but you can always email investorrelations@organicgarage.com. Please do, because look, I'm never shy about speaking about the business. I love it. I'm passionate about it. I'm super excited with what we're up to. So please, if you can't get your question answered on this program, investorrelations@organicgarage.com. Send your questions over. I'll always do my best to answer it with our IR team. But look, the potential's there on the Organic Garage side. We're working hard on that 4 to 6 store package. We want to take a big step forward, but look, it doesn't stop there. It's what I said about when we put the word out there, the snowball started to roll. So when you start looking at, in the next, 12 to 18 months, what is potential? What is 18 to 24 months? What is 24 to 36 months? And you fill out that pipeline of stores, the potential is definitely there for the markets that we're looking in to hit that 20 to 30 stores, which is our goal. It's keeping us very busy for sure.
20 to 30 stores. So potentially in 18 months, you could have 20 to 30 stores.
Well, I don't want to guarantee anything, but once again, when the word's out there and you start filling pipelines for stores, over a certain time period, things start to fill up fast. And we knew it's usually a delayed effect. We launched that press release, in the summertime. We knew it would take 4 to 6 months to get sites starting to trickle in, and we got inundated. So we had to sort through them. Then we start selecting them. Then we start plugging them in, and then people start seeing announcements. So they start, hey, I got another site. Would you be interested in this? And things can happen very rapidly from a store development standpoint.
Yeah, and just to get the last thing I just want to point out is, okay, so these stores, you can open basically 4 at once. The construction, everything can pretty much go simultaneously. I think one of the questions, and we've addressed this, maybe you want to address it again, is that, okay, people were, okay, is this guy going to have to raise money? Is there going to be dilution? But, we've talked about the fact that there's a lot of, financing, because there's and it's actually minimal cash outlay to open one of these stores.
It is. There's lots of things that we get back. We have landlord inducements. We get money back for our inventory to stock our stores, because you get 1 free case per SKU per store when you open. All that stuff comes off the top in terms of CapEx. You're absolutely right, Jack. We have lots of alternatives in terms of financing. Equipment is like 75 or 80% of a new store. It's easily financed because it's a hard asset. And so we'll always look at those alternatives to minimize CapEx requirements, and then, in terms of capital that's needed to grow. But what we always want to say is we would never stop growth of the company because we're afraid of, selectively raising. If we can take a big step forward in the company, which is beneficial to all shareholders, for us to take our next step, we would never shy away from that. And I can't stress enough.
Not at these prices, not at these levels, though, right? Not at these
levels. No, we would always be prudent.
Not even below $2. I don't think below $2.
We would never do something unnecessarily. But we want to take advantage of the opportunity that exists in the market. And with our unique kind of financial model in terms of the CapEx required, it's relatively minimal on a per store basis. That really allows us to grow rapidly with minimal capital required.
Okay, Matt, but no capital raised like below $2 or $3 though.
We won't do it if we don't have to. Absolutely not.
Okay, so yeah, I mean, and look, you've been very good about you had plenty of opportunity to raise money at 70 cents. You didn't, so I'm assuming the raise is not going to be. It's not going to be a dilutive, cheap raise. Okay,
we'll be very
I want to thank you, and we're going to catch up with you very shortly on the next big news announcement.
Appreciate it, Jack. Thanks a lot.
Thank you again. Okay, let's get ready for VSBLTY Groupe. Let's pop this up on the screen. The man of the hour, Jay Hutton. Jay, welcome. Mike? Oh, we can't hear you.
How about now, Jack?
Oh, great. Wow, it's
I was
unbelievable.
able to figure it out without calling IT.
Unbelievable. Okay, hang on a second. Let me just get this set up. And we're gonna do the today. So today we're gonna do the slide form. Slide. You can do video. What do we do?
I've got a 4-minute video in the can that talks about some of this stuff has been seen by people before, but some of it's actually a piece of it is brand new. And part of what I want to do today is engage in a kind of a soft launch of some new initiatives that we have.
Oh, so you're going to show something new then? This is going to be a new relative. Okay.
Something new.
So because we have a lot of new people in the audience in general. So I kind of wanted to start off 22 with explanation of what VSB does, all that good stuff. So do you want to have it ready on the screen?
Sure. Let me share right now. See how this works.
Let's see. We've got a lot of people here. You have a big fan base.
I'll try and do right by them.
Yeah, we'll get it queued up on the screen, and then I'll do the intro.
So can I just share? Excuse me. Can I just share screen?
Yeah, just the button below it says share screen. You can do.
There we go.
Okay.
Now see if you can see this, Jack.
Okay, so right now I'm seeing the whole screen, but you got to share the. You're sharing an app there, right? You're sharing. Oh, here we go. Okay. Okay, looks like a video is about to come on.
Yeah. Would you like me to just jump into this and we'll pick it up afterwards?
You know what? Let me do a quick intro for anybody, and because for the video later, and then you can start. Okay.
All right. Fair enough.
So just put it on pause, and I'll do a quick intro, and then we'll get into it. Okay. Welcome everybody to Wall Street Reporter's next Super Stock live stream for January 13th, 2022. We are back with VSBLTY Groupe, VSBGF, over-the-counter VSBY in Canada. One of our favorite super stocks that's already up. Increase from, I don't know, 17 cents to almost $2 pullback. So there's an opportunity for another bite at the apple. And possibly, it could be a 10x from here. So we're going to find out today. Guys, please ask your questions. We have a lot of people in the audience. I think we've got a lot of very smart people. So hopefully we'd have some great questions. And then you can decide for yourself if VSBLTY Groupe is going to be a 10x from here again. So with that said, Jay, let's start with the video intro here.
Okay, just a quick setup as to what this video is. For some of the audience, there are a lot of people that are quite familiar with the organization's objectives and what our software looks like and how it performs. So some of that's a recap for those people. And of course, I didn't want to jump in and not share for the new people what we are and what we do and why we do it. And then the back half of this video is a little bit about some of the things that are fairly uncommon about VSBLTY. And my suggestion would be maybe not fully appreciated by some of the people that follow us, our participation in some unique initiatives. And then at the very end, I'm going to talk to you about something we're just now in the process of launching. So I'll just let her go. I'm going to jump into the pieces that I mentioned just a second ago, which is VSBLTY has these hidden value accelerators. I'm going to start with Austin GIS. We launched Austin GIS. Well, we joined Austin GIS in August of 2021, last year. It's, I guess, about a 6-month-old company right now. In Austin GIS are 5 equity participants. VSBLTY is one of 2 independent software vendor participants. Tech Mahindra, a $20 billion Indian SI systems integrator. HCL, a $17 billion Indian SI. systems integrator, and a large semiconductor company. I'm told that they will quickly identify themselves, but they haven't at the moment, which is quite frustrating for me. But it is what it is, and they call the timing. I don't call the timing. And the objective of Austin GIS is infrastructure as a service, large infrastructure deals. The company's already in revenue. It's got a global reach. It's now doing business in, I think, 6 countries. Large project focus. The focus of that organization is 200 million plus. As I said, it's already in revenue. And the critical piece about Austin GIS, 2 important critical pieces. Number 1, we're a 10% equity participant. And secondly, we have an exclusive deal with them where the product is, where the delivery methodology is retail or security, it's exclusively our license fabric. A little bit about what Austin GIS is doing and focusing on, just because people don't have an appreciation for this. I wanted to take a moment or two to share with them. These are the infrastructure pieces that Austin GIS is doing. And again, the focus is on very, very large deals. Significant pipeline growing at the moment, and some examples of how they would deploy. The idea here is Internet of Things, or IoT, consumes capital dollars, but many entities that are interested in IoT infrastructure, some examples here, can't afford that infrastructure. So the idea is that Austin GIS brings banking relationships and brings software solutions and systems integrators. The system integrators are critically important because they are the deployment capability. As a reminder, so for some of the people that are following the company's momentum, Tech Mahindra is the deployment partner for us in the Winkel Media deployment, which is the AB InBev joint venture in Latin America. So you can imagine that in other deals of equal complexity, the availability of not 1 but 2 systems integrators with a combined employee headcount over 300,000 people, those are critical elements of delivery model, and that's why they're critically important. The second sort of not well understood component of the visibility business model, in my opinion, is Radar USA. This is an entity that is now growing here in the US, is already in revenue as well, with multiple contracts under their belts. The basis of the creation of the company is 2 foundational licenses, one from our partner in Mexico called Radar App, and the other from us. We're doing the computer vision pieces of it, and they're doing the all the plumbing and infrastructure pieces of it. Creating a new company in the USA with focus on homeowners associations, police departments, and mining and solar. And that is projected to be 25 million by the end of 23. VSBLTY is the largest equity participant in that company. And in addition to that, we have a $2 million non-refundable prepaid license that will be paid in the first half of 22. The third sort of accelerator that actually, I'm going to go through some of the components of Radar USA just by refresher for some people. As I mentioned when I began this, that there are some people that really don't appreciate what Radar does. So there's I don't know, maybe it's 2 minutes on what the Radar pieces are. This is computer vision, active and alive in one of our deployments, facial recognition, license plate detection, vehicle classification. These are live, not live feeds. They're live, but recorded. And an example of what we're doing actually now for 3 targeted police departments to start with, one mid-Atlantic, the other East Coast, and the third sort of Midwest, doing both person of interest and weapons detection in the interior of buildings to allow for situational awareness for first responders. Where's the shooter? What kind of weapon does the shooter have? And we're doing things like breadcrumbing, which is identifying not only where the shooter is in real time, informed by cameras deployed in the building, but now, as this slide shows, where the shooter is and then where the shooter was. Teal would be where the shooter was, red would be where the shooter is, and on the bottom you're seeing what we call the workflow. We see a weapons detection alert. It goes to a dashboard. Think of a real-time crime center or a 911 center. Security assesses it, validates it, human in the loop. This has a lot to do with eliminating liability. So we don't want the robots to make the decision. We want people to make the decision. And then the police arrive based upon a workflow that might include a building lockdown. This happens for the purposes of interior protection. And now, as we'll describe in the next 15, 20 seconds, in exterior detection as well. The DNA of an active shooter in the US has a lot to do with weapons brandished prior to entering the building. So if we could turn the exterior cameras, many of which exist already, into not only doing CCTV, but also looking for weapons, we could tangibly impact building safety. So the idea is connecting a weapon detected to a human validation and a workflow in seconds, not minutes, to create benefit. So moving forward, the third one, which is Winkel Media. I'm not sure how common or aware people are to the name of that company, but that's the name of the joint venture in Mexico City that it's AB InBev, Retelligent, which is our local partner in Mexico City, and Visibility. Components of that deal. Visibility gets licensing revenue as well as 33% of the media value. The media value is projected to be $250 million per annum by the end of year 4. That's a consequence of between 45 and 50,000 stores. And independently at run rate by the end of that 4th year, 10 million in annual license revenue. And we're also right now underway with AB InBev and Winkel on 2 additional collaborations that are using computer vision for other uniquely valuable outcomes in retail. So that's brand new IP. And the last component of this deal that most people don't appreciate is the option that AB InBev has to buy roughly a 10% ownership position in Visibility for $14 million. So I wanted to highlight those because I think that they're sort of not well appreciated. And this is how we position ourselves as a growth company, not just with respect to our own organic business, but also our participation in other initiatives. This is the soft launch that I was referring to. And after this, I'm done, Jack, just as a preamble. National Retail Federation event, which is the largest gathering of retail participants annually, was meant to have happened in New York City this coming week. It's still going to happen, but like CES, it's going to be a shadow of what it was intended to be. And our participation is finally announcing a consortium that we've developed over the last several months. That consortium is led by Intel, WPP, and Visibility. And we've done 2 things in preparation for this. There'll be a series of soft launches, some social media, but most importantly, there's this creation of a metaverse virtual store. And if you can see the QR code in the lower right-hand corner of this slide, if you scan that QR code, it'll take you to a place where you can download the app on whatever form factor you have. And in addition to that, you can get a 50-page white paper that was co-authored by the 3 participants I just mentioned and several other consortium members. Why is this important? This now, for the first time, puts us in a place, and the company we're keeping is I'm very proud of. And we always knew that the store as a medium idea and concept would really catch fire when that consortium was put in place. It's now in place. And over the next several days, it will be formally deployed. This is what I might call a soft launch. If you can go to storeasamedium.com, you can pick this up. You can scan the QR code. You can pick it up that way. And what you'll find is not only are our partners talking about the store as a medium, but Visibility's unique role within it. And interestingly enough, also AB InBev's role within it as well. So for the first time, we're getting AB InBev to talk about the strategy of the store as a medium and what their expectations of it are. So we're really excited about these set of materials. As I said, it's going through soft launch today. It'll go through formal launch in the days preceding NRF. So that's what I wanted to share, Jack.
Okay, let's get back. Okay, so Jay, let's get into some questions. So I just want to touch on, so the Austin GIS, which I think, this is something you've been kind of hinting at for the last, couple of months. It's a lot of people are wondering what this is. To me, it seems almost like now you actually showed on a slide, like some of the things. I would call it almost like they're offering a smart cities in a box solution. Would that be fair to say?
Yeah, I think in addition to that, it's smart city in a box, fair enough, but retail analytics in a box, security solutions in a box, all of this financed as an infrastructure, as a service offering. And I think that last piece is important because the barrier to entry for municipalities that want to engage in this and take their city to the next level, the barrier to entry is usually access to capital. So if we can eliminate that, or at least mitigate it, turn into an operating expense and turn into a 5, 10, 15, 20-year contract, it becomes more reachable for many of these municipalities. And that's the hypothesis of Austin GIS.
Okay, so it's like a SaaS model for the city. So that way, basically,
everything. So yeah, the hardware, the software, the services, the day 2 management and support, the deployment and installation activities, all of that under a SaaS model.
Okay, so this is basically essentially a city. It makes it almost hard to say no. I mean, you're making them an offer they can't refuse. I mean, they're going to have this tremendous opportunity where they can, increase revenues, for the city, right? Whatever different fees, reduce potential crime, increase convenience, all the different, and we can go through all the different aspects of the different services. You're providing kind of the AI analytics aspect for the camera, which is kind of the key ingredient for a lot of it. And we've talked about, and all the city has to do is essentially sign the contract, and this thing goes to work immediately. So they've really.
This is why it's so compelling. It is not just new revenue, but it's efficiencies and the ability to turn city services into AI complemented or supported services, which is very important to cities. In addition to that, just as a quick reminder, the plan that was approved by Congress in the USA included $65 billion for exactly these types of services. So part of what Austin GIS is doing is building a support capability to help municipalities understand how to access those funds, because it's never clear. It's always difficult to navigate. So that's part of it. And but just as a quick closing comment on Austin GIS, the scope is global, right? We're already talking to entities, not just cities, but enterprises on a global basis.
So it's interesting, and you gave one example of a small use case, not exactly like this, but like, for example, in Mexico City, like in a certain area where a mayor installed just your kind of the security function of what VSB does, which allows them to track, I think, are cars left what is it called, abandoned, or is there whatever, is there all the different stuff, and it really transformed, I guess, quality of life there.
Yeah, absolutely. And so if you look at Mexico and you try to put that in the box that is Austin GIS, just to sort of close on that, is you could either spend many millions of dollars in capital dollars to equip 50,000 stores, or you could sign a 5 to 7 year contract with someone like Austin GIS, and what you're paying now for is activated stores on a month-to-month basis, in light of those stores creating advertising revenue. So now you've actually got an economic model that pencils. So you're spending X, you're making Y. And as long as Y is more than X, you've got an economic model that's scalable and workable. And that's precisely what we're doing in Mexico City with Austin, with AB InBev across Latin America with AGIS. On the security side, you're exactly right. It's improving city services, adding to the security envelope, increasing and measuring security sentiment. So all of that is enormously impacted by the stuff that we're putting in place with Radar App and with Austin GIS in Mexico.
Okay, yeah, I mean, on that slide, there was like a lot of really interesting features. Each of these, addresses a massive opportunity, and again, it seems like a no-brainer for a city to deploy this, because they don't have to.
A city, a private enterprise, a large developer, multi-building, university, schools, hospital. Those are the target markets. It's not just limited to municipalities.
Okay, let's get to some audience questions. And again, you have 10% of Austin GIS. That potentially could be a $50 billion business.
Well, the players,
valuation wise, I mean,
all you need to look at, in my opinion, and again, I give you the perspective of a small cap CEO. The reason we made this investment decision, which cost us $1 million, is it secures our position, and we get a right of first refusal on all business that touches computer vision. So that's a great decision, just good commercial decision. On the investment side, we're side by side with an equal voice to 3 companies whose market cap exceeds $20 billion. And for us to be in that company, just exposes us to deals we would never be able to touch otherwise. So that's the validation.
Okay, let's get to some audience questions. We got a bunch of things coming. Okay, so Samantha saying, Jay, congrats on the hard work and progress. Can you speak on the following? Security in U.S. schools, government and other cities similar to the Mexico deal. And can you speak where the run rate is currently? Where's revenue? 3 questions. Wow,
yeah, I can't speak in detail to the annual ARR or the run rate of 21 because we're closing the books now. I can speak in generalities. We're very pleased with a record year, and on top of what we expected to do in Q1, Q2, Q3, Q4, our minimum expectation was doubling revenues every quarter, and I think we managed to achieve that in 21, and in the fourth quarter significantly achieved that. So the idea here is that we're in the middle of an inflection, right? As software as a service, as I've said to you many times, has this sort of non-linear growth rate where 1 goes to 2, goes to 4, goes to 8, etc. And we're experiencing that right now. And most importantly, we're experiencing that within the marketplaces that we address are themselves inflecting in the same fashion. So we're inflecting within categories that are inflecting. So it's kind of a good position. So in terms of guidance for 22, which I haven't delivered yet, the guidance I gave for 21, I think will be close. Certainly on the bookings basis, and guidance was 15 to 20 million. We'll have done that, I think, for 21, and we'll be very close, if not over, for the revenue guidance. And then for 22, which was for 22, the revenue guidance hasn't been provided yet, but the bookings guidance is probably going to be double that of 21. So I'm delighted with how we closed 21, and more interested and delighted by some of the things we have underway at the moment.
Okay. Do you think you can do 50 million? You can hit 50 million bookings in this year, 22? We'd require
a couple of longer term deals to make that happen. And the reason why I say that is there's a couple of deals in flight at the moment that were they 5 to 7 years, then the booking would be a manifestation of that term. And that would be the way we would make that kind of number. And there's a couple that are possible in that regard, right? Austin GIS has long-term deals. That's the basis of their business. So almost nothing we do with them is going to be a 2 or 3 year deal. It'll be a longer-term deal, which I would argue will manifestly impact the overall market cap of the company, because that long-term deal is basically more or less in the bag money. So
it's an annuity. It's an annuity.
Yeah.
It's like it basically turns you into a blue chip stock. Really, it's sort of like a. I think we talked about Brookfield as one of these players in that space. This infrastructure financing and things like that. So essentially,
well, I want to remind the audience to work we did and announced in late last year with Milan Innovation District, which is a very interesting urban regeneration project run and managed by Lend-Lease. And our relationship with Lend-Lease is advancing and getting strategic, and Austin GIS is part of that conversation. So I'm not projecting where that'll go, because you never know. Negotiations are what they are. But that's the kind of thing that would really impact us in a very positive way. Multiple visibility-based activation types over a long-term contract.
Okay, so let's say even in a I don't know, I'm going to throw out a number, but like in a small city, one of these contracts might be for like, I don't know, let's call it 20 million a year, and your portion might be 2 million a year. Possible?
That's possible, sure.
Yeah. Okay, and then you multiply that by how many cities are there on the planet that are in need of increasing revenues for the city.
I don't want to be I don't want to be a broken record, but don't limit your thinking to just cities, because universities are little cities.
Oh, right.
You know,
Airports.
enterprises, yeah.
Yeah. Business parks. I mean, you know, the Apple Center in where are they in wherever they, you know, it's a city basically. So yeah, we're talking about massive opportunity. Okay. Okay, so in theory, you know, the stock could hit $1 billion valuation in the next 12 months, just based on kind of where you're going with bookings plus the catalysts, you know, the upside with these three different aspects between Austin GIS, what do you call it, the radar, and of course Winkel, which we know of as the disco cooler, store as media in Latin America, expanding to the US. Let's get to next question here. Jeremy saying, Jay, you mentioned other large retailers like Walmart are creating their own store as media. Have you approached them to see if they would rather go with the experts in the field?
I'm not sure how I deftly answer this question. There are multiple retailers in the USA and elsewhere that have created their own media companies, but they suffer the following limitation. If you're Walmart and you're going to Procter & Gamble, the only thing you're able to represent in terms of media spaces is Walmart. But Procter & Gamble wants to buy everybody. They don't want to buy just Walmart, because that limits the reach to the, I mean, it's a pretty good reach. That's the truth, but it is still limited. So Walmart, in their desire to build media, will be extending opportunities to folks like us that will help them activate that media in retail and expand their horizons beyond their own walls. So for example, I have to be cryptic, but there's an initiative right now with Walmart and with Target around a brand new product that's coming to market. That company has approached us to help them create digital activation, and together we walk in with that company to that retailer and we broaden the scope of their reach within that retailer. And that would be the type of way we would engage with a Walmart or a Target or one of the big established players that have developed their own media company. So the fact that they've developed their own media company is more of a validation of the store as a media channel than it is, you know, a barrier to entry.
So I noticed when you answered the question, you said how you could deftly answer the question. Does that mean, like, are you in talks with the Walmart? Is there a partnership? Is there something happening with Walmart where you want to be?
I'm not trying to be stealthy. There's never a time when we're not in talks with Walmart. Either that's directly with Walmart about activations in the various countries. Remember, we're fairly deep in Latin America. Walmart has significant presence in Latin America, just as an example. And we've already gone through multiple pilots with Latin America Walmart, right? And you know, I'm not going to speak about the conversion to production because that would be a little bit of front running. But we are very actively engaged with Walmart, both in terms of deployment in store and by having been walked into Walmart by brands with whom Walmart has an existing relationship. Large beverage companies, with whom we do a lot of business. The largest order we took in the fourth quarter was a very well regarded and well known beverage company. So that's an example of the type of thing that would allow us to be more strategic to Walmart, as an example.
Okay. So yeah, let's keep going. We got a bunch of questions, and I'm going to ask you my questions at the end. So I want to get to the audience questions first. We got a bunch of good ones here. Jeremy's asking, can you elaborate on the consortium with Intel and WPP?
I can. There'll be more to come in the coming days, and I would encourage anybody who got the opportunity to download that QR code to go and look there, because there's more data there. It also identifies the other consortium members, which I think people will be impressed by, or go to storeasamedium.com. But really quickly, if you understand what's in it for these big agencies, and WPP is the largest agency in the world. So you might ask yourself, what's in it for them? Why are they interested in advancing this novel concept of store as a medium? Well, because they consider themselves to be at risk. If you look at their biggest revenue, or one of their biggest revenue spots, it's in media purchasing, media buying. And if you look at our momentum in Latin America right now, which is fairly pronounced on the media side, how successful we are being in getting brands to buy presence on the network that we're building, those brands are now directly engaged with the network owner, us, in deployment of advertising. Well, that removes the media agency from the conversation. Well, that media agency is WPP. So when they get removed from the conversation, they view it to be an existential threat. Is this the beginning of the end? Or can we continue to play a dominant role in advising our large brands, Coca-Cola, Unilever, etc., on how to buy and what's the strategic way of buying media? They don't want us to develop a relationship with the brands. Because they would be disaggregated if that was the case. So, or disintermediated, I guess is the proper word. So that's why they can't let this marketplace take off. Remember, BCG, Boston Consulting Group, says this marketplace is worth $100 billion over the next 10 years. It's the most important media channel since the internet.
Store as media. Yeah, this
Yes.
This is the next big thing. This is the last frontier.
So WPP cannot be on the sidelines, nor can Publicis or Ogilvy or any of the major players. They cannot be on the sidelines as this channel fortifies itself.
Jay, we got about 30 questions. Today is gonna be like a town hall format. We're just gonna ask you audience questions.
Okay.
So Frank is asking, saw a video on LinkedIn a while back showing the coolers, the disco coolers, as I recall them, I think in the Northeast US. It appears to be a VSB employee that shared the video. Can Jay comment on, is this Austin GIS or is it the Modelo?
Guerrilla marketing, I guess. So that we rarely do retail deployments with Austin GIS, save and except what we're doing with them with AB InBev. So I don't think, at least domestically at the moment, we're not looking at significant pipeline with Austin GIS in retail. Possibly as we evolve, but not at the moment. So if you're seeing an activation, I think that particular one might have been Penn Station. That was deployed through one of our other partners. If you think about who our partners are, the largest partner that has a long-term strategic relationship with Coca-Cola, as an example, which that deployment was, is Westrock. And Westrock is, I believe, the supplier of the year 3 times running, year over year, with Coca-Cola. And our relationship with Westrock, though 3 years old now, is getting significantly more strategic because of the demand coming from companies like that.
You know, Jay, I think the common theme, the common thread kind of running through the whole story is you're really able to leverage these. I mean, there's some tremendous relationships with these blue chip companies that have existing relationships with all these key markets. So like all you're really doing is supplying this, this AI, your AI technology, and you're kind of leveraging their whole infrastructure, all their things. So it's, I mean, it's
well,
it's pretty impressive.
Let me respond to that. So because just in case any of my staff sees this, it's not all we're really doing is providing the AI, because they would be offended by me validating that assumption. I think what we're doing more accurately is, and this is not, we're providing the subject matter expertise, which is ridiculous. We're guiding the large S&P component company, as an example, to opportunities, and we're helping them think through the strategy, which I know sounds obscene and maybe even outlandish, but the truth is that's exactly what's happening. We have to bring these old school companies into today, and digitization and digital transformation requires that of us. So, and we're finding ways to extract monetization out of that exercise. So we're not just a SaaS company, we actually getting other benefit as the subject matter experts. So, and that's part of what maybe the big change that we're going through right now in visibility. We're adding 14 headcount just in the first quarter, because the process of the company is now putting so much pressure on the people that are driving these engagements that we need to add more people. Otherwise, we risk failure of execution. So I don't have a problem with that, because I'm not a guy that wants to add headcount that's disconnected to revenue. All these people are connected either directly or indirectly to revenue objectives, and that's how I can come that's how I'm at peace with it, right? Because we're excited about some of the opportunities we're being given, and not willing to suboptimally execute.
Okay, so it's kind of like, essentially you're almost like the McKinsey of you're adding this value add in terms of help, making this whole thing work for them, between the AI, the technology department.
Sure. Yeah. I think that's right. And
Stores media, digital transformation.
The white paper that I reference is a 50-page white paper, which goes through the entire industry and talks about the major inflections and our role, in addition to the role of others, within that ecosystem. Why is it going to work? Who are the players, and what's the narrative and ROI around the exercise? And that's why I'm fascinated by it. It's going to take a consortium, and that's the litmus test.
No, but it's very interesting, because you've kind of wedged VSBY into all these different things, where all these guys are really, maybe I shouldn't say this, but they're all doing the heavy lifting, I think, and essentially you're providing the IP and collecting this, essentially a gross profit royalty and all this.
It would surprise you. I'm not saying that you're wrong, but it would surprise you that how strategic we must be in these engagements, and how much of a thought leader we are in these engagements. It would surprise you, because when you look at the list of companies, which people can go and do it at storesmedium.com, not one of them is small. They're all mammoth companies. And the idea that we're guiding as the spiritual leader is kind of insane, but we have this unique role to play. And, for the time being, because we benefit as this marketplace, as a generality, inflects, we're going to continue to invest in that exercise.
Chris is asking, can we see a PR on the security deal you mentioned with a sovereign government? What's the status on that?
It's always a difficult one, because this particular sovereign government has made it very clear what they wish us to say and what they don't wish us to say. So yes, I think we'll see that in Q1, but just be prepared for it to be slightly cryptic. We do owe our shareholders disclosure, and I'm a big proponent of that. But on the other hand, I will not risk the equity of our shareholders, or the value of our shareholders, or the value of the company by being a cowboy. So it will get out, but it might get out cryptically.
Mark is asking, I think this is related to, okay, so Austin GIS, at some point, I think there's a possibility for this to be a publicly traded company.
While I am on the board of directors, I have heard no conversations around public IPO for Austin GIS. I believe Austin GIS, which, by the way, has an interesting restriction on its resale. The parties at the table right now, in particular one, have a unequal right, or inequitable right. They have a right that others do not have, to buy the company back, to suck it back in. So I expect that's the more likely exit path, which at the end of the day, I'm okay with, as long as we retain our 10% equity participation.
Okay. Chris is asking, what are the main catalysts for the next 60 days? Wow, this is the great question. Next 60 days.
I would say, please pay attention to the subtleties and the relationships that we're crafting around this store as a medium, because I think it's really important to the company. That narrative is beginning today and tomorrow, and will extend over the next little while. We're fortifying our partnerships in that area, and some of the partners you'll see listed again at that URL, storeasamedium.com. You'll see that some of them we haven't announced any kind of engagement with, so we're working on those. I think we've got some security deals in Mexico City. I would say this with comfort, that we deployed in the month of December alone with our partners. We deployed more than 3,000 cameras just in that month.
3,000 cameras in
3,000 cameras in 1 month. Yeah,
that's a huge number.
A huge number, and we're surprised at ourselves, actually. And that honestly, that credit does not go, at least not directly to my staff. It goes to the on the ground staff, and then our guys were working all-nighters to make.
That's the thing. I mean, because of the partnerships that you have, they do all the physical. I mean, in other words, it's you have a very asset light. It's everything is partnership. So you have these guys who already have the infrastructure. They're doing the work. That's why they're able to scale.
That's true. I would tell you that my guys in California would say, wait a minute, we stayed up awful late a few times. but yes, they do most of the heavy lifting. And I guess the last thing in terms of what can we expect in the next 30 to 60 days, we're very proud of a couple of international partnerships which we'll be announcing soon, and both of which will go almost immediately into revenue. So I'm really delighted about that, and more to come on that.
Okay, so the 3,000 cameras, just to clarify, this is for the radar-related deal in Mexico?
Right.
Okay, that's actually, that's a big number. So, because I think people probably in the back of a lot of people's heads are saying, hey, it sounds good on paper, can they do it? But this is that's a lot of...
One was a brand new county, and the other was an existing customer that added more cameras. So it's good on both ways, right? It's a validation, or it's a reorder, if you will, and a greenfields opportunity.
It's a double validation. Okay, so you have a reorder. That's number one. Number two is that you get this a new deal, and the fact that you can actually get this done. Because again, one of the things people were asking is, hey, can these guys scale? Are they just putting out press releases, or can they actually scale a real business to go?
Well, I mean, you got to be
$1 billion.
I get it, and I'm an investor too, and I have exactly the same observation. But the reality is, software as a service grows month over month. So we don't announce a $30 million deal because we closed a camera network worth 10,000, 15,000 cameras. We grow our business on the basis of $5 to $10 per camera per month, depending upon the inference logic that's running on the camera. So even 1,000 cameras deployed in the month of December, just to make it up, is between $5,000 and $10,000. So we're not talking about something that has enormous impact. But if you take the TCV, the total contract value of that contract over 3 years, 5 years, 7 years, now we're talking meaningful revenue. And that's
also more cities, other places. Right. You could layer on additional services. So now it's not even $10, it becomes $30. There's a lot of once your foot is in the door with these, it's like it really becomes
right, because inertia is your enemy, and then inertia is your friend. Right? You overcome the inertia to get in, but then once you're in, then the disruption associated with your removal is just too much for many people to overcome.
Yeah, John is asking, what's your relationship with Microsoft to see that they have been added to the partnership tab on VSB website?
We like Microsoft, and versions of our product consume Microsoft Azure. And if you follow Microsoft at all, you know that everything Azure. Microsoft has done a really kind of a remarkable job turning their company from a one-time revenue company to a recurring revenue company. And an example of that is Microsoft Azure. We pay them an enormous amount of money every month to have our systems running on Microsoft Azure. So we're considered to be strategic to them mostly because our product is architected with Azure in mind. They're enormously poor, in my opinion, on optimizing channel relationships, but we've recently added a former Microsoft person to perform that role for us, and that's why I think you're seeing the profile steadily rising. I'm skeptical because I know Microsoft is relatively poor in end user engagement, but if we can find a way to motivate them, then we will do so. Having said that, they would probably sit on the second tier of our partners as opposed to the first tier. But the opportunity is to take them from a second tier to a first tier. They appreciate what we do. It's completely unique in terms of their ecosystem. So I think we've got an opportunity to rise in profile and in importance to them.
Okay, so we were just talking about, in Mexico City, right? You're doing the camera deployment. I think one thing that's been kind of talked about, mentioned, is India, right? Like India has a need for kind of what you're doing, very similar to Mexico, right? I mean, what's anything happening there?
India is a strategic country to us and important to us. And, I think that we've got a couple of opportunities that we are pursuing in India, which may or may not manifest. But, it's very similar to Latin America in lots of ways. The retail landscape is, I'm going to turn into a shopper geek for a moment, but traditional trade versus modern trade. And probably people understand what that means. Traditional trade is all of Latin America, almost all of Latin America's traditional trade, mom and pop stores, small footprint, you know, owner operator. India is exactly the same way. Mom and pops, 9 to 15 square meters. That's 30 to 40% of all retail commerce in India. And we have a unique value proposition in traditional trade. Having them turn their stores into media used to be a place that only the big boys can go, but our Latin American experience has manifestly shown that we can take that model to mom and pops. And if we go to India, it's using those learnings to get there.
Okay. Tony's asking, has COVID tripped up your goals or timelines with these verticals?
Yeah, COVID had two 2021 impacts for us, and could possibly have similar impacts for us in 22, although I think we've done a good job in navigating it. The first impact COVID had for us in 21 is supply chain. Probably 4 times we had to stop installations in Modelorama and Latin America because we ran out of stock, either displays or compute or cameras or sometimes all 3. And you know that we have Intel as a partner who are sort of bullying and navigating the supply chain for us. And that's enormously valuable. And we wouldn't be in the position we are in now in terms of number of stores deployed were it not for them. But it was a problem. And an example is for a large beverage company, we had products sitting in a boat off of Long Beach for 71 days, just waiting for port. So that kind of thing has manifest impact and cash flow impact, you know, in terms of credit terms and that sort of thing. So yeah, we've been impacted. That's one way. And the second way is bringing Tech Mahindra up to speed in installations and management. There's probably 70 people that we had to bring up to speed just in Mexico alone. Navigating train the trainer, which is training somebody smart and have him train or her train other people, was impacted because you train a guy or a gal and then they get sick. And so it's had enormous impact for us. But I think all in all, I'm pretty delighted with how we've exited the year and feel comfortable that we'll continue to meet our metrics.
Great question from Chris. What kind of revenue deals can we expect in terms of the electric charging stations? I don't know, Jay, maybe you want to just kind of address like how, you know, what are the applications, why somebody would want to use your technology, how they're using it. And this is a massive, this is going to be the new gold rush, electric charging stations. We already see ChargePoint, Blink, those stocks are going crazy. All they need is now your AI they did for this, you know.
Well,
charging station as media.
Forgive me for the redundant reference, but that store as media app that I referred to includes how we activate with EV charging stations. So let me just give you the crib notes version. When you go to an EV charging station, you're either there for you're there between 15 and 30 minutes. And at least now, right now in the current marketplace, we know who you are because there's an enrollment process, right? It's either you identify that by credit card, license plate recognition, whatever. When you go to a charging station, your identity is known. When your identity is known, we can laser target ads to you. So our proposition in the EV charging station, and it's mostly represented by our first deal with EOS, where they're doing 500 and some odd charging stations in the city of Atlanta, which has just gotten underway this month, delayed because of COVID and because of municipal approvals and just a bunch of junk you got to navigate when you're doing EV. But the business proposition is Jack's going to sit there and charging his Tesla or his Volt or whatever, and he's going to sit there for a minimum of 15 minutes. Well, we have the opportunity to drive personalized advertising to him at that moment. So who's going to buy that? Well, everybody's going to buy that because all the brands on the planet want a personalized approach to their customers. So we got dwell time working in our favor. We got personalization working in our favor, customization working in our favor. And because we've got computer vision, we can tell when Jack left his car to go to the restroom or to enter the store. And there's other metrics we can use to sort of double down on the value of Jack as a single impression. So we know that an EV charging station is a dodgy or sketchy economic proposition. But when you add digital display, you take it over the top in terms of its monetization abilities. Not everywhere, but in most places, right? If you put a charging station in, at mile 50 of Route 66, and there's nobody else there, it's not going to be a valuable advertising space. But if you put it at a 7-Eleven in 4 slots, and that 7-Eleven sees 4,000 visitors a day, that's a super valuable platform. So that's our proposition. We've got that going not only in Europe, but in the USA, but also in Latin America as well. So I expect more from that. It's a business development initiative at the moment because we're still sort of finding our way, but it is a very compelling opportunity.
I would think that essentially that the VSB, this technology is going to be the key. I mean, to making any profit in EV charging. Basically, is this the security ad component essentially is so you're going to have to. I don't know if you can choose size who you're going to go with, whether it's a charge point or Blink or whoever, or you're going to be a arms dealer to everybody. But this is going to be like an essential thing for them to really.
I understand it to be critical. I was meeting with the CEO of a large incumbent utility in Europe. I don't know, maybe October, and he told me that they had deployed, I think, 3,000 charging stations with 100 charging stations incorporating 60-inch digital display, which is sort of our story, right? And the only charging stations that were actually making money on a month-to-month basis were the ones that had digital display deployed. So that's not you can't extrapolate that across the marketplace, but it's an interesting anecdotal validation point. And so we're looking right now, we have a dedicated executive who's responsible for this category. We're looking for increasing validation. And again, if you look at what Austin GIS is bringing to the table, you could see that combined with Austin GIS, we could take an economic value proposition to a large EV infrastructure company saying something like, we'll pay for all the digital display upgrade, and we'll secure the bulk of the media revenue associated with it, and we will use Austin GIS financing to get there. So
it's okay. So now I understand how this Austin GIS fits in. So one of the things that Austin GIS can also do is, are they in the electric charger? Can they set up charging stations?
No, they're purely a tech stack company, or tech stacks, multiple, and the financing that goes around it.
Okay. So in theory, a place like, let's take a place that wants to be like a very green, whatever, let's call it, I don't know, LA or whatever, so LA doesn't have any money, right? So Austin GIS goes to them and says, hey, we're going to put up these cameras, all the stuff to basically make you a smart city, to cut down on all the crime that's going crazy right now there. And of course they love the EV, the charge. I mean, this is a big thing. So, and of course they're going to have to, and this is where you fit in with the ads on all the EV charging stations and the security and everything else.
Again, we're still seeking broader validation, but the early returns look good. I mean, the early numbers look really good. And I think you'll see us in Q1 do something with some large convenience store base that are interested in the EV idea.
7-Eleven?
In that category.
Okay. So very interesting. Okay. I mean, in theory, so another aspect of the VSB story is essentially, if anybody wants to play the EV boom, they can buy, one of these charging station stocks, or they could just buy VSB because it gives you the same exposure essentially, but with more diversification and better margins. Because
I'm not, just to conclude on the EV story, I'm not suggesting that 100% of the EV charging stations across the footprint of the US will have augmented digital display. But the 30% that are in high value, or the 50% that are in high value locations, will absolutely have digital display. It's a no-brainer. Now, the question here is, will we be that digital display? And so that's why we're engaged in the business development activities now, not only with direct retailers, as I mentioned a second ago, but also with those that are doing and building the distribution networks. That's probably the more intelligent place to go because it gets you the scale.
We got a lot of questions. Jay, you have time? I think we got like 40 more questions.
Yeah. That's a lot.
I don't know. We got a lot of questions. Let me see if I can jump through it. It's hard to edit them. Okay, so Let me see if I can. I'm trying to understand this question. What an interesting. What other business opportunities can you get from these large camera networks? What else can you leverage from these?
Location data, car data. When we get mobile attribution, not to get too much into the weeds here, but when we get mobile attribution, we can identify that a 25-year-old male is in a location. And if in addition to that, we can get mobile attribution data, which is anonymous mobile ID, then not only can we know that that person is at this location, but this is where else that person was. And that's the mobile ecosystem as opposed to our ecosystem. But when you combine the fact that Jack's at a Modelorama at 2:45 in the afternoon buying Corona, and his day was at this location, this location, this location, it's a really valuable consumer data.
Okay. Jason asks, can you give an update regarding execution of Modelorama installations? That's the disco coolers, right?
Yeah, no, these are not coolers. They are the displays that are part of, you know, that video that I run with yeah. So it's the display at the end of that video. That's the principal deployment modality. There are pilot coolers in Mexico, but they're only in pilot at the moment.
Okay.
So our deployments, we're happy with the deployments. AB InBev is very concerned about strategic followers. And they want to get enough of this is a traditional trade deployment. And by that, I mean, think of it as old school display or trade as opposed to modern trade. And they want to get enough of an edge on competitors so that they can't quickly emulate. So they basically muzzled us with respect to talking about the cadence. However, by the time we file our 2021, the cadence will be obvious. I'm overall happy with it. I'm not entirely happy with some of the supply chain challenges, but I'm also delighted that our speed starting this year and the 14 or 15 days is up quite a bit. Our objective is to get to 200 installations per week. We hit that briefly in late November until we hit to supply issues, and then we hit it briefly last week. And then I expect that as we reach that and sustain that, we're going to be back to a place where we're happy.
Okay. A really interesting question. Samantha is asking, can you speak to the value for VSBY per camera added to the network? In other words, every camera, what's the value of the camera? Because that increases the value of the network. This is the traditional, the whole internet model. Right?
Okay, so I'm going to answer the question in two ways. I'm going to answer it with respect to most of the retail applications, and then on the security side. On the retail side, we license a camera, depending upon the deal, between $5 and $10, actually as much as $12 per month per camera. That's the retail side. And the reason why there's a range is sometimes we have media participation and sometimes we don't. So where we have media participation, we discount the license because we want it to grow, right? Because if it grows, it has more value on the media side and there's more dollars there. On the security side, we have a base license, which is between $8 and $10, and then we charge per algorithm. So if there's a license plate detection algorithm, that's an additional $2 or $3. If we have a zone crossing algorithm, identifying when people move from a non-restricted area to a restricted area, as an example, that's another $3. And we add up the algorithms that are deployed on the processor, and we make money per algorithms on top of a base licensing model. That's the best way to answer it.
Okay, so but I'm thinking it from like the strategic overview, like the camera, for every camera that comes onto the network, that's probably worth X amount of dollars for the enterprise value. I'm thinking of like,
yeah, you're going at the value proposition from a different perspective. Yeah. I'm answering it from a licensing perspective. These are the hard dollars we get when we deploy a camera. But then you ask yourself more generically, what's the value of the camera and the data that camera collects?
Right, the data.
That's almost impossible to properly quantify at this moment, but certainly more.
Will you become profitable in 22?
We almost got there at the end of Q4 on a month-to-month basis, but yes, I expect we will be. I'm not gonna at this point project a date, but on a month-to-month basis, I expect we'll turn the corner in 22.
Okay, let's see if we can just do one last. Okay, okay. Here we go. Last question. Save maybe this is the last question. Okay, in your opinion, what's the major catalyst for VSBLTY? I think I picked the wrong question. I'm not sure. This is like an open-ended question. I don't know what this means even. Jay, you want to take a shot at this? What's the most important thing that you have in the pipeline right now, which could drive the stock? Maybe that's what this guy's asking. Is it
well,
the security?
I think that this might be disappointing to you know, maybe you're looking for a different answer, but the most important thing that we spend time on every week as an executive management team is maximizing the AB InBev deal. Were we to do nothing else, we're 3 or 4 times the market cap we are today if we get that thing to its maximum potential. So I'll tell you the truth, we're doing other stuff for sure, but that is an enormously important focus of the organization, and probably has in the neighborhood of 9 to 10 people who do nothing but focus on that deal. And I defend that because, you know, that deal on an annualized basis is somewhere in the neighborhood of $50 to $70 million for us when we get to full run rate. So I defend us focusing the time on that. And if we execute the way I believe we can execute, the Manifest spinoff is going to be significant and will be significant. It's happening now.
Okay, so the main priority for the company, I mean, because, you know, we talk about all these different growth initiatives, but the main priority where the real money is going to be made in the short term or whatever it is the Modelorama deal.
Yes,
not
not just because of the contract we signed and the support and, you know, the detail that I've shared on that contract, but we've actually got 2 more development initiatives inside of AB InBev that we're working on to add more capabilities to that exact same network. So, you know, we're talking about a company and a partnership that is going to continue to pay dividends for us for 5 to 7 years.
Okay. So bottom line is there's enough catalysts in the company right now in place which could, you know, result in, you know, $1 billion plus at least $1 billion plus valuation in the next I'm just going to say in the next 12 months.
If we execute and we optimize the deals that we have in the bag now, then we're in for a significant value growth. Yes.
Okay. And that note, Jay, I want to thank you. Thank you everybody for the great questions. We'll see you all in the next live stream.
Thank you.